Picture this. It's 2015. Two guys from Columbus, Ohio, are sitting in a coffee shop, and they're thinking about something that's bothered them their whole lives. They're thinking about injustice. They realize that millions of safe drivers are getting punished because of where they live, because of their credit score, because of their age, and they think, well, what if we could fix that? They create Root Insurance. And for a moment, a beautiful moment, the entire world believes they're about to change everything. But by 2022, it all crashes. A 95% stock collapse, billions in investor wealth gone. This is the story of how the best idea in the world collided with reality. Let me take you back. 2015, Columbus, Ohio. Alex Tim and Dan Manges are looking at the insurance industry, and what they see is broken. Think about it. A single mom working 2 jobs gets charged triple for auto insurance because she lives in the inner city. A young professional in the suburbs pays half that, even if he's a reckless driver. Where's the fairness? Where's the logic? That's when it hits them. What if, and this is the key insight, what if insurance wasn't based on stereotypes and zip codes? What if it was based on one simple truth? How you actually drive? Root Insurance is born. Download the app, drive for a few weeks. Their algorithm watches your every move, your braking, your acceleration, how you handle corners, how fast you go, and here's the promise. The better you drive, the cheaper your insurance. Pure fairness, no discrimination, just mathematics and reality. The tech world loses its mind. Venture capitalists see it and think, yeah, this is the future. By 2019, Root has raised $523 million. They're valued at $365 billion. On Reddit, early adopters are posting screenshots like they've won the lottery. I just saved $50 a month just by not being reckless. Forbes publishes a glowing profile. TechCrunch can't stop talking about them. This is it, the moment when a scrappy startup with a smartphone app is about to take down the dinosaurs. And then October 20 happens. Root goes public, IPO at $27 per share. They raise $724 million. Wall Street erupts. Analysts are writing reports with bold predictions. Market cap, $6.7 billion. By the end of the year, they have 340,000 customers. For that one moment in time, everyone believes. Employees think they're going to be billionaires. Investors imagine their victory laps. Root isn't just a company, it's the future. It's destiny. And they're so close to being right. But here's the thing about reality. It always shows up eventually. Behind that beautiful app, behind the viral moments and the hype, something unsettling is happening. Root's entire theory rests on one assumption: that a smartphone can accurately measure how someone drives, that an algorithm can replace 150 years of insurance expertise. That data alone can beat human judgment. Except the real world doesn't work like a spreadsheet. GPS fails sometimes. When your phone sits on the passenger seat instead of your hand, the sensors misread everything. A pothole your car rolls over gets registered as aggressive acceleration. Your passenger's phone in the cup holder distorts the entire data stream, and suddenly careful drivers are getting punished for things they never did. Imagine this. You're a safe driver, you follow the rules, you've been using Root for months and you're proud of your driving record. Then one day, your rate jumps. Why? Because the algorithm decided you drove recklessly. Except you didn't, you were being careful. The algorithm just didn't understand the difference. How does that make you feel? Betrayed, right? But there's something darker happening too. Root is collecting every piece of your driving life. Where you go at midnight, which restaurants you visit, how fast you drive on each street. You know, that's not just data points. That's your privacy mapped and stored in a database. And investors, they're not concerned. They see growth exploding. That's all that matters. But look closer and you see the cracks in the foundation. Customer acquisition is costing over $300 million in 2020 alone. And here's the hidden horror: churn. People download the app for the discount, then leave the moment they find a cheaper rate somewhere else. Root is spending hundreds of millions of dollars to acquire customers who are just passing through, It's like pouring water into a bucket with a hole in the bottom. Then 2020 happens. COVID empties the road. Driving patterns change overnight in ways nobody predicted. And Root's entire competitive advantage, understanding real-world driving, falls apart. The algorithm has a complete meltdown. Claims costs spike, marketing expenses keep climbing, and the brutal truth becomes impossible to ignore. Technology alone can't replace decades of expertise. You can't data science your way out of 150 years of actuarial knowledge. By the end of 2021, Root has lost $521 million. The bleeding isn't slowing down, it's accelerating. The IPO magic dies faster than anyone expects. The market wakes up, investors stop believing in the narrative and start doing the math. Cold math, real math, not venture capital math, actual financial math. Customer acquisition costs are astronomical. The algorithm isn't as accurate as Allstate, State Farm, or Geico, companies with decades of historical data built by thousands of actuaries. The dream that technology could replace human judgment isn't failing quietly, it's failing expensively and publicly. The stock starts falling, $27 per share, then $5, then $3, then $1. Billions in investor wealth just gone. People who believed they were buying into the future are watching their money disappear, and then panic sets in. Root tries everything. They partner with Carvana, the online car dealership. Carvana invests $126 million. It's a desperate lifeline. They license their technology to other insurers, essentially surrendering their original dream of being the future of insurance and accepting the role of a tech vendor instead. Layoffs happen, hundreds of employees gone, office closures, marketing budgets evaporate. The company that moved at lightning speed is now just trying to survive, but the damage was always too deep. Root grew faster than its business model could possibly support. It was like building a rocket with an engine designed for a bicycle. The economics never made sense. They were burning cash faster than they could raise it. And investors don't forgive that. Not when reality finally arrives. Here's the twist that makes this story unforgettable. Root actually did change the industry. Traditional insurers watched from the sidelines and realized telematics-based pricing works, just not the way Root tried to do it. Now every major insurer uses behavior-based discounts. Allstate, State Farm, Geico. They all looked at Root's vision and thought, that's actually brilliant, we should do this. Root proved the concept had genuine merit. But here's the tragedy. Being right about the future isn't the same as surviving in the present. And that's what makes this so painful. By 2024, Root is a shadow. 341,000 policies, $455 million in revenue, still losing $147 million per year. The company that was supposed to disrupt a $200 billion industry ended up disrupted by reality. But listen to this carefully. This isn't a story about fraud. It's not about corruption or ego. Root's founders believed in their vision. They genuinely thought they could out-engineer decades of industry expertise. They couldn't. And here's why. Insurance isn't like software. You can't iterate fast or fail cheap. Insurance is built on decades of actuarial data, regulatory frameworks, capital reserves, and risk management protocols. It's designed to be cautious because when you make mistakes, real people suffer real consequences. Someone can't pay their medical bills. Someone loses their car. Someone's family struggles. Root tried to move at Silicon Valley speed in an industry built for caution. Those two speeds are incompatible. It's like trying to fit a Ferrari into a tortoise's body. They underestimated the complexity of human behavior. Driving patterns are infinitely more nuanced than algorithms can account for. They underestimated the weight of regulation. Insurance is one of the most heavily regulated industries in America, and they underestimated the capital required for long-term sustainability. You can't raise venture capital forever. Eventually, the music stops and you need actual profitability. Root made the classic startup mistake. They confused innovation with inevitability. They had a brilliant idea, they raised billions, they went viral, and they assumed the rest would follow automatically, but markets don't work that way. The universe doesn't owe you success because you had a good idea first. So what's the real story here? Root didn't completely fail, it didn't completely succeed either. It did something more meaningful. It forced an entire industry to evolve. Before Root, traditional insurers were comfortable with their old ways. After Root, every major player had to adapt. Telematics, behavior-based pricing, digital-first experiences. The insurance industry of 2025 exists differently because of what Root attempted in 2015. That's genuine disruption. Even though Root didn't become what it dreamed, the lesson isn't don't innovate. It's the opposite. It's that real disruption requires more than a good idea and venture capital. It requires patience. It requires understanding your industry deeply. Not just the surface, but the constraints, the incentives, why things work the way they do. It requires sustainable economics. It requires knowing that sometimes the fastest way to win is actually the slow, deliberate way. Root dared to challenge the impossible. They didn't conquer the market, but they changed it forever, and that's a legacy worth remembering.